Okay, so let's go to the next product. I want to explain adjustable rate mortgages. And I have a really good PowerPoint that the company gave me. And, I have something that Samir's built me in the past. Doesn't really cover ARMs, but I could have updated that and made it look a lot prettier. And I thought, I want to show you guys an actual sheet. I want to show you guys how to understand pricing a little bit more also. So I just figured I would get an actual screenshot, showing the guidelines and showing some of the more nitty gritty stuff on how these loans actually work. So stop me at any time, and this should be pretty simplified too. So I wanted just to do a direct comparison today for 30-year fixed versus a 3-year, a 5-year, and a 7-year, and then how the ARM products actually work. So this is for a jumbo loan. Any loan amount above $715,000, actually any loan amount above $646,000 in Orange County, but soon that's going to be $715,000. The Fannie Mae loan limits are going up again, if you can believe it. Amazing, right? To $715,000. We are going to have a jumbo Fannie Mae option above $1 million. Why does that matter? Conventional loans, when you hear about a 5% down payment, you can go with 5% down now with a loan amount of over $1 million when we have our new loan limits for next year. Right now, you can do 5% down to a $970,000 loan amount and still be on a conventional loan, right? Where it's a Fannie Mae loan. No other lender will lend with that little of money down. But so this is based on any loan amount above the standard conforming loan limit. And nationwide, Fannie Mae will buy mortgages, insure mortgages, be involved in mortgages. They will do any loan to $646,000 nationwide. Then you have high cost areas like Orange County. They'll go to $970,000, right? But to go above that standard conforming amount, it's a little harder to qualify. You can do 3% down to a 646 loan amount, but when you go above that, you got to put 5% down. Okay.
So Reed, real quick on that, and I just want to make sure because this is something I've always kind of wondered as well. So Fannie Mae and Freddie Mac, those are the people. Are they the people that insure or guarantee they'll invest in the loan as long as it meets their criteria? Or how? What is their that's their role in it, right? So they're basically saying, as long as it meets this criteria, we'll lend on any loan you produce in Alabama for this price and this loan amount. And if it's Orange County, high cost areas, we'll do more than that, right?
Exactly. And Fannie Mae and Freddie Mac used to be separate institutions, but they were the biggest buyer of mortgage-backed securities, mortgage bonds, right? And then they allowed all these bad loans to come through the system, and they bought all this crappy financing that didn't work out from 2004 to 2008. And then as a result, they went bankrupt, right? And so the government came in and bailed them out. There was something called TARP, and TARP is when the government bailed out all the banks with $780 billion, and that was around 2009 to get us out of the last lending crisis. When they did that, they said, we're going to take control, though, of Fannie Mae and Freddie Mac. And that's when they changed lending guidelines, where they made the debt-to-income ratio requirements lower. They dropped it to 40%. They made down payments were required. You had to put 20% down. They also bought all of the bad loans that were out there and then put all the new loans through a funnel with great qualifying guidelines. And over time, everybody was on a conventional loan over time, right? There's none of that bad debt left. And so now the government still effectively has ownership stake in Fannie Mae and Freddie Mac. So it's not a government-backed company. It's not a government company, but it really is, and it's owned by them, and they're just controlling the real estate market with it. And that says a lot about our employment market and our wage inflation growth. They started to raise the Fannie Mae loan limit from $417,000. They started raising that in 2015 because they saw that the economy had recovered a lot and that jobs growth was finally getting back to a pace where there were enough people working and there were a lower amount of available jobs where wage inflation could start happening again. People weren't just trying to get a job. They were actually getting a new job, getting a couple % more in pay. Their pays were going up. And we saw that happen in 2015 after the market really recycled itself and recovered from the downfall of 08 through around 2013. And so as a result, Fannie Mae started raising their loan limit from $417,000 to $424,000 to I think $432,000. They just kept raising it until now. The national conforming loan limit is $646,000. It's going all the way to $715,000 next year. We're already lending on that amount, but it's going to $715,000 next year. This is a good point to bring up to clients about appreciation and about the jobs market and just the overall. The government is the one buying all these loans, and they keep raising the amount that they will lend at. Clearly because the jobs market is so freaking strong. And I'm not going to get into a long talk about that right now and do a market update because it's going to throw us off track. But just know the conforming loan limits have a lot to do with affordability and the ability to buy at a higher price. And they keep raising them. So very, very good sign. Okay, so this loan amount I'm talking about today right here for this example is just a loan amount above 646. Okay, I want to start out there. And this is to give you guys just a difference and an example of how ARMs on jumbo loans, okay, are going to be a little different than 30-year fixed, and then how do ARMs work. So today, whenever you see this price right here at 100, what that means is there are no points. It's zero. See, zero. Zero would mean 100 on a rate sheet. Anything above 100 is a credit back to the borrower. Anything below 100 is a cost to the borrower. And it's based on percent. So 100, if you go down to 99, it's going to be 1% of the loan amount in cost to the borrower. If you stay at 99, or if you go to 995, it's a half of 1% of the loan amount in cost to the borrower. 100 though is par. It's called a par rate. Okay, no discount cost to get a lower rate, no points, and you're not getting any credit for that rate. Okay, so 30-year fixed 6 1/8 today. As you can see, the refinance interest rates are higher. There's less refis in the system, and they just require a higher interest rate than a purchase loan. Also, when someone refinances, they may not keep the loan nearly as long in a lender's view versus somebody that buys a house. Refi rates are priced a little worse usually because when someone buys a house, for the most part, they're going to keep the loan for at least 12 months or even longer. When someone refinances, there was a thing that happened where people were just refinancing every 6 months, every single 6 months, every 3 months even, because there's no limit there's no prepayment penalty, no penalty to refi. So as you know that's the reason why refi rates are a little higher. Okay, so 30-year at 6 1/8. Now, jumbo 3.6. This could simply say 3.1 also, but 3.6, 5.6, 7.6. 3.6 means the first numeric here will always be the amount of time that the loan is fixed. It's fixed for 3 years. After that period, it can adjust. The rate can adjust every 6 months. Pretty much every loan a while back was 3.1, 5.1, 7.1, where your adjustment to the rate would only happen every year after the fixed rate period is up. But because of interest rates and the projection for rates being so bad right now, lenders, they don't want to lend money at a short period of time without being able to raise the rate quickly after the fixed period is done. So you're seeing, instead of giving you this yearly grace period, where traditionally how an ARM loan works, it's fixed for the initial period, and then every year after that, on a specific date, your rate can adjust up. It could adjust down even if the rates have gone down a lot. But generally it will adjust up, and it can adjust up by a certain amount. When you see 3.6, 5.6, or 7.6, but not with a 1 there, it means every 6 months it's going to be able to adjust. So I'm very cautious on jumbo or on ARM financing because of that. I think a lot of people are, but this loan can still make a lot of sense if you think you're going to sell or you're going to refinance in 3, 5, or 7 years. But I think if you have your borrower that wants to play it safe, but also wants a lower rate and believes in the next 7 years, they'll probably be able to refinance. So I got a great thing I'm going to talk about in a minute about why that's very likely you'll be able to refi, and something you guys can take with you. But if they believe that, but they want to be more frugal, pop them into a 7-year. Don't pop them into a 3 or a 5-year. Also, the qualifying on a 3-year is very hard. Your debt to income ratios, your income ratios have to be a lot lower. You have to make a lot more money to do actually a 3-year loan versus a 5 or 7. And the government does that on purpose. They're requiring lenders to make it harder to qualify for these types of products because they know that they're what's called risky mortgage products. So again, 7-year is the safest way to go, and you still deal with a lower interest rate than the 30. Now, the rate on a 30, let's say 6 1/8. The rate on a 3-year, 5 3/8. The rate on a 5-year, I should have highlighted that, is 5.5%. And then the spread on a 7-year is 5.625. Now, why are 30-year rates still pretty attractive? Because the spreads between what you save doing an ARM versus doing a 30-year fixed are still not that, the gap is not that wide. If it was like, hey man, I can do a 4.5 or 4.25, 5-year ARM, or I can take a 6.5 30-year fixed, that's when you're going to start seeing adjustable rate mortgages become a lot more prevalent. And we may move into that market. It's getting very close to where you may start to see that.
Reed, can I ask a quick question on that? So one of the things we saw like in the 2008 crisis was there was a big difference between adjustable rates and fixed rates. It seemed like there was a bigger difference. So there was like an incentive to do an adjustable. Now it seems like there's not as much spread. Is that because the government now is running Fannie Mae and Freddie Mac and they're like regulating it? Does that play into it at all?
So the reason why, it has a lot to do with the yield curve. I'll talk about that for a minute. Okay. So to answer your question, I'm going to try to make this like simple and not over explain it because I can go on tangent. So the government is controlling everything right now. The government is controlling everything. Let me say that again. They're controlling everything. The government during the pandemic issued all this debt because they had to create debt so they could have money to fund all of the lending facilities to prop up the economy. Okay, so you hear about treasury notes, and then you hear about mortgage-backed securities. Then you hear about the Fed's balance sheet. Their balance sheet is how much debt that they hold. Okay, what they were doing is treasury debt is essentially our own country going, we need money, we need a loan. So we're going to print a bunch of our treasury debt, and we're going to offer that debt to the market, and the market can buy that debt. And the market, it could be big banks, institutions, hedge funds that have 10 billion of capital they have to make a return on. So they might buy 5 billion of stocks, and they might buy 3 billion of other types of investments, Fannie Mae mortgage bonds maybe, that pay a little bit higher rate of return than treasury rates. And then they might buy a bunch of US debt. And why they do that is it's the safest debt in the world. Our economy is just a growth economy. We're a service-based economy. Everybody spends money on services here. We don't produce as much. So as a result, our debt is very, 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 very safe. And we can just keep on printing more of it, which the government continues to do. They just print more. But the rest of the world believes in our economy a lot. So they will buy our treasury debt. So the government bought all their own treasury debt. They'd issue treasury debt and then buy it back and put it on their balance sheet. By doing that, they amassed trillions of dollars of treasury notes, specifically over the COVID periods, right? Now, when they talked earlier this year about doing quantitative tightening, quantitative easing was when they would just keep buying all this debt. So they put it into the market and then they buy it back. And then that creates demand for it. So the rates can stay low. If they're issuing it and buying it at a low rate, okay, then they can keep the rate artificially low. But they said, we got to get rates up. How do they get rates up? Well, they start selling their treasury notes on the market. Someone else has to buy it. Other institutions, other countries have to buy it. Well, with how low our treasury note was, man, to buy a two-year treasury note, it was paying you like 1.25%. Doesn't pay you a lot. So as they started to do what was called quantitative tightening earlier this year, they started to sell that debt back to the market. They flooded the market with that type of debt, with this treasury debt. And as a result, when they flood the market with it, the rates have to go up for the market to then buy it. And that's what's pushed up treasury notes, okay? So now the treasury notes, you're seeing very high rates on treasury notes. Now, talking about the yield curve. Normally, let's look at this right here. Your one-year treasury debt normally would be paying much less. Then your two-year treasury debt would be paying less, or excuse me, a little bit more. Then your 5-year treasury debt would pay you a little bit more. Then your 7 and then your 10 would be paying you the most. So if you bought 10-year treasury debt, you'd be getting the highest rate of return. But when the economy believes the recession's coming, which has already been brewed in, the economy needs cash. So people that hold treasury debt, banks and institutions, they need cash for their reserves. They start dumping their treasury notes, okay, along with the Fed doing that. And it pushes up the rates on short-term treasury debt, higher than long-term. I'll give you an example. The 2-year treasury debt today is paying 4.3%. Doesn't show it right here. I have a graph I could show you guys, but the 2-year treasury debt is paying 4.3%. Our 10-year treasury debt is paying 3.863%. So that's out of whack. It creates a yield curve is supposed to go like this. Okay, it's supposed to go like this. Instead, right now it's like this. It's like this. Boom. Whoa. Okay. It's inverted. Okay. Normally it's supposed to go like this. 2-year, 5-year, 7-year. Oh, you get the highest rate of return at 10-year. But everybody's selling their short-term treasury debt along with the Fed. The Fed has been releasing. They're doing quantitative tightening where they sell a lot of the debt they have into the market. They flood the market with debt. Rates have to go up high enough to where the market buys the debt. And that's causing your short-term treasury yields to be much higher, okay, much higher than your long-term treasury debt. So how does this equate into mortgages? Short-term money is expensive. Plain and simple. Short-term money is expensive. And there's less money on the secondary market that is buying 3-year, 5-year, and 7-year ARM debt right now. They're going, I can buy 10-year treasury debt, the safest debt in the world, and make almost 4%. Or I can lend it out on an ARM and make 5.5%, and it's tied to real estate, and it's more risky. And there's less buyers of that type of money. And the last time that we were doing loans in 04, 05, 06, when there were a lot of ARMs actually in that time, there weren't a lot of ARMs after that. There was no adjustable rate mortgage financing in 2010, 11, 12, 13, 14, 15, very little. And I'll give you guys some math on that in a second. But before the last real estate crisis, over 50% of all the loans out there were adjustable rate mortgages. And it's because we were not in the type of economy we're in now, where the government is controlling money flow. It was totally out of whack. But it was a free market, but it was different, okay? And so back then, the rate on a 5-year, because the 2-year debt and 5-year treasury debt would have been so much lower versus the 10-year, the cost of capital also would have been so much different in that type of, setup that the ARM pricing would have been maybe 4.5% versus a 6.5% 30-year fixed. So my point is, as we get to where the market is more comfortable on where we're moving, as the short-term treasury debt starts to, as those yields come down, because not everybody's selling the shit out of it, because we're not so afraid of what's going to happen in the next 2 years, you will see the yield curve come back in play. 2-year debt will start here, 5-year, 7-year, 10-year debt. Right now, again, boom, it's inverted. You'll see that, you'll see the yield curve flatten, you'll see it get better. When that happens, I think then you'll start to get better ARM pricing again, where you'll at least have bigger spreads. You'll see a 5-year loan at 5.5. You'll see it at 5 1/8 versus a 6 1/8. You'll see a full percent. You may even see 1.25% in spread, but you're not going to see it until the Treasury market cools down. And you're not going to see the Treasury market cool down until the Fed has a control over inflation. They're going to keep artificially pushing rates up.
Just to make sure I understand that correctly. So basically you've got the secondary market, which is the treasuries and the securities. And so you've got a lot of people selling their treasuries and putting their money in short-term treasuries. So like the 2-year treasury, right? Because they're giving a higher return on that. And because
there's some that are buying that now, but it's actually the opposite. They're selling their 2-year debt. That's what's caused the yield to go up. The more people buying the debt, the lower the yield, the lower the rate of return. The less people buying the debt, it causes the yield to go up. And by going up, it's okay, now demand is there. Like you already have, if you Google a 10-year treasury note today or 2-year, it's paying, 2-year is paying 4.3%. It's now high enough, it's not going up too much more than that, it looks like, because people are buying it now. Big hedge funds and everybody are buying it. They're going, shit, I can add fixed income in my portfolio and be making a guaranteed 4% on treasury debt? That's stupid. Of course I'll buy some. But not enough people are buying it yet to make that yield go down a lot because of the Fed being so hawkish. It will maybe even go up more. It could even spike to 5%. But at some point, it's high enough that the market, there's enough cash and it'll be buying it up. So again, it's all supply and demand, Stephen. It's all supply and demand. If there's less buyers of treasury debt, then the rate on that debt has to be higher. And again, there's less buyers because the Fed is selling all their treasury debt onto the market. They're doing it on purpose. So even if there's buyers right now, they're going, this is a great deal to buy fixed debt. The Fed makes up over 60% of all buying. So if they're out of the market and they're actually selling, they're not buying it, and they're actually selling it right now. It's a double F. That's why rates have doubled in 6 months.
Cool.
So at some point that'll stop though. That'll stop. They'll even start buying up their own debt again. The minute they have inflation under control, the minute that we have the job opening and labor turnover survey, that's that JOLTS report, that was at 11.1 million jobs available last month, and it dropped to 10,050,000. Thank God. Jobs are evaporating off the market, and we're still hiring a lot. It's a good combo. It's a strong economy, but we're getting rid of some of the jobs that are not needed. Okay. The minute that JOLTS report is down around 7 million jobs available, or 7.5 or 8, you're going to see a big change in treasury debt as well. The government will start rebuying back their debt again. Okay. Because now they can rebuy it back and it's going to pay 4%. Right now, the debt that they're selling to the market, remember when the 10-year note was under 1%? Google 10-year note during COVID. It was so low because the government was printing it and buying it at those rates. Nobody else wanted to buy debt with that type of a return. This is no return, but the government was. And so the rest of the world followed too. Some of the safe haven was to buy treasury debt because the stock market was going down some days 7 or 8% in a day, right? So there was some demand down there, but only because the Fed was buying it that low. Now you have the opposite thing happening. And until they get inflation under control, they will continue to use selling that debt as a way to keep pushing rates up until they know it's high enough to cool down the economy.
Awesome.
So again, so does that make you guys got me on that?
Totally. That's amazing. Thank you for breaking that down. So as we look at this into the adjustable rate mortgages, what it looks like, I'm gathering, kind of bringing it into the real estate realm, it seems as if the adjustable rates are almost, there's just not, it doesn't seem like there's that big of a difference right now. It's almost as if these might not be, like, it seems like the 2-1 buy down is almost a better program than this right now. But like, how should we be using this to communicate with buyers, and what type of person is this a good loan for right now?
So somebody that is, I just had a client move down here actually from the Bay Area, and they're going to be working out of Irvine for only 2 years. And they still would rather own than rent. The rents are almost as high as them buying a house. And then they get the tax deductions, obviously, when they buy, and they don't want to have a landlord. And they may end up staying longer if they like the area and asking to stay longer. But they're only probably going to be here within, like, let's just call it 3 years. Like, they're sure they're not going to be here in 3 years. They don't like it. They can get put right back up there. For somebody like that, it's very payment sensitive. It may be a better option to put them into an ARM product. I would do a 7-year, not a 5, although a 5 is still going to be good. Like, it's still 5 years if the rate's fixed, right? For somebody that makes a lot of money, that has very low debt to income ratios, and it has more maneuverability if their rate was to adjust higher, but they're more comfortable with doing an ARM because they want to keep their payments lower. And they may be somebody that sells a house every 5 years and buys another $5 million home. They have all their investment properties and stuff, but they may do interest-only loans. There's a good interest-only loan available for somebody that's wealthy that wants to do a $2 million interest-only loan because they want to keep all their principal. They don't care about paying down the loan over the next few years. They'd rather keep that money in their investments. So they don't care about paying off their loan. There's certain people that will do an ARM or an interest-only product, but this product is not for somebody that is conservative unless they, are definitely not going to stay in that property for 2 or for 3 years. They may just be moving in to sell it soon. And even then, though, somebody that's conservative but that sees the market and they like the payment better on a 5-year, it's still good to talk about it because the chances rates do go back down again where you can refi on a 30-year fixed in a couple of years from now and have a lower rate than today. There's still pretty high odds on that.
So essentially for the adjustable rate people, it sounds like for them, it is, people who are cool with getting a little bit less of a payment right now, knowing that it could go up in 7 years because there's a rate cap, which I'm sure you're going to get into. And then B, maybe, they want to put their money elsewhere. Maybe they want to put less down and have money in their investments or their stock or their crypto or whatever that's producing better for them. And they're fine with having a little bit of a riskier payment because they know they'll be there, for maybe 5, maybe 7 years max. And interest rates have been below 6.5% for 20 years now. So it's unlikely that they're going to go to, 7.5, 8.5, 9.5, right? Like that's
exactly. Yeah. It's even if they did short term, if it really does take that to slow the ship down to where they want it, which there's already so much data. I could give a 2-hour talk right now on all the data that is slowing. Oil prices back up right now due to Saudi is not good, but we're still not dealing with $120 a barrel oil. So let's just say, though, if it really does take like 2 more years to slow down the ship and rates really do have to go to 9.5 on a 30-year fix, they will still in the next 5 years come back down to where I believe what you just said is pretty factual. They're not going to stay above 6.5 forever or for that long before the economy will slow enough that then you will see rates come back down again. Okay. You may see the Fed start to cut their federal fund rate, which I'm sure they'll do in the future. So I think that's a very good analogy. And I think what we can look back to, people always want to know a little bit of history to have an idea of what the future is going to hold. And we're in very unpredictable waters, so you want to be careful on this. But there's a really simple one that you can revert back to that was just a few years ago. So when we had tax reform in 2017, there was tremendous wage inflation because companies, their corporate tax rates dropped to 18%. So all this extra money they had, they paid it to their employees. They gave a lot of pay raises. And so wage inflation went from about 2% a year all the way to about 4% very quickly. So annual wages were increasing at a 4% a year pace. much higher than what the Fed wants. The Fed found that at a 2% growth rate, the economy is the most under control, the most predictable, and is growing at the safest pace for employment to stay where we have a full employment. Everybody has an option for another job, but they do have to work, but it's not like they hate what they do too much and they can't find something else. That's like stable employment. They want to be at 2%. Well, it was at 4%, way too high. So the Fed raised interest rates all of 2018. They raised rates 4 times at every live meeting. A live meeting is when they actually are probably going to choose to raise or not raise rates. And back then, they had a live meeting every quarter. Right now, it's every month. It's a live meeting every month. That's how scary that it is. Every quarter, though, they raised rates. All of 2018. Okay, 4 times they raised rates. By the end of 2018, they had pretty much almost overhyped. And we saw inflation really starting to cool. And throughout the year, remember, rates went all the way above 5%. We were at 5.25% for a primary residence that year. Then it started to trend down the last couple months of the year when we finally saw wage inflation was starting to cool down. Then starting in 2020, okay, right before COVID, 30-year fixed rates were 3.625% again. They were 3.625 with no points, no buy down points, none of that. They were 5.25 with points. They came down to 3.625 with no points. And the Fed only cut their rate a quarter. It was still at, their federal fund rate was 2 to 2.25% when rates were 3.625%. 2 to 2.25.
So Reed, so it sounds like one of the biggest things, it sounds like, plays a role in where rates are going, where and what's going on, is it sounds like they use interest rates a lot to kind of help with the monetary policy. And what you're saying is that in 2017, when Donald Trump cut the tax rate down to 18%, that had a real impact on how much people were making. Their wages were going up so fast, and so they met to the Fed met to raise interest rates as a tool to be able to slow it down. So that's awesome. I really appreciate you sharing that, because this is really good perspective. This is this kind of stuff that we need to know to be able to speak with a little bit of authority to our clients. Could you, before we summarize the point on the ARMs, could you dive into rate caps a little bit and maybe use this as the summary for that part? Absolutely.
So again, you guys can see the spread on ARMs is not very big for the reasons I defined. Let's come down to the rate cap. So on that 6 now, right? Not the 3-year it's fixed for, but on the 6 or the 1, you might see a 3-1 or a 5-1 or a 7-1. That just means every year it can adjust after the fixed rate period. Down here you have your fixed term, so it'll show you how much that these can go up or down. This can go down too, by the way. It could adjust down. It will, but it could. It very much could. You can get an ARM today and you might be adjusting down in the future without even having to refi as rates turn back around. You might see that. You might very well see that. SOFR, that's the secured overnight finance rate. This is just like the overnight rate basically that institutions are getting this money at on a 6-month term. This doesn't really affect, you don't need to ever dive into that. That's way too complicated. Just fixed term, and then the rate caps. Rate caps mean how much can my rate go up or down every adjustment period, and then what's the max it can go to. That's all it's saying. So if you started at a 5.625 on a 7-year loan, okay, right here, this is what scared the shit out of me, is I'm like, why would they have this on 7? This is interesting. The market really does believe rates are going higher. So just remember that. This may be a more prevalent product in the near future, but right now it's not quite as. 7-year, it's saying 5%. Rates could technically adjust up or down by 5%, okay, on the first adjustment period. So the initial adjustment period is going to be higher than the periodic adjustment. So you have initial and you have periodic. The initial is just, hey, the first time that my loan can adjust, how much can it adjust? Well, on a 3 or a 5-year, it can adjust up by 2%. Okay. And then the next year, if the rates were higher or high enough to where it needed to adjust higher, how high can it go? Well, every year after the first adjustment period, it can only go up or down by 1%. And then the lifetime cap is over the life of the loan. How much higher can my 5.625% get? How much higher? It can go up by 5%. So it could be 10.625% when it adjusts over the amount of time it can adjust to max. See, this is saying in 7 years, they're going, look, man, we're giving you this money for 7 years. And to get a better price on our secondary marketing in Wall Street when we sell this loan, we are going to say that you're going to get hit with a 5-point initial adjustment. So just in case rates are a lot higher at that time, it can go up by 5%. This total lifetime cap could take effect right away. Same thing on 10 years, okay? And why they're doing that again is this is just to get their coupon package pricing better, and that's really why they're doing it. But I still think it's just interesting when you see that. The 5 and the 3 year are only at 2, so that's good to see. But again, the rate can adjust up by 5. So again, your fixed term, your initial adjustment, how much can it go up? The periodic is every year thereafter, and then the lifetime cap. Also, I want to point out.
Just want to summarize real quick on that. So if I get a 5% and it's a 7-year ARM, in 7 years, it could go up to, is that a 5 on that 7-year?
Yeah, it is a 5. I thought it was weird looking too, but that is definitely a 5.
So in 7 years, it could jump from 5 to 10. It seems like the 3 and the 5 year, those could only jump 2%. So if I get it today, in 3 years, if it's a 5% today, it could go up to 7%. And then every year after that, it could go up more, up to
by 1% every year, and
okay.
It could go up, and it could go up as much as 10.
And at that point, I could always refinance into a fixed rate if I needed to.
Why I like the 7-year, even though I don't like this is not good, is it's 7 years. This is a Fed-induced recession that we're in right now. If they have to push rates to 15% to get it slowed down, they're going to do it. And once it's slowed down a lot, the rates will fly back down, guaranteed. So it's just, 7-year is still safer, even though it's 5%. And this is where I do want to tie in the secured overnight finance rate. So you hear like LIBOR, or you hear coffee index or SOFR. These are just basically, it's saying like, hey, this is what the market yield is, and then this is what the bank is adding on top of that. Okay, so if you ever do hear about, well, if your client says, well, what's the index on? Say, you need to talk to my lender. You don't need to dig into it too deep. They probably won't even ask you this stuff. This is stuff I dig into with them. But again, like, if you want to know why does this term, the 6-month term, matter? Why does the index this is tied to matter? Is that it's the index is what the actual rate is. And then you can find out based on the lender what their margin is that they're putting on top of that. You could kind of almost judge different lenders amongst each other. So I use this one because Chevron Federal Credit Union is phenomenal. And this is where I would send an ARM right now. I think that these spreads are pretty good compared to other ARM products. The Fannie Mae ARM too, you're starting to see a better spread on that, Stephen. So you are seeing as the 2 and the 10-year Treasury notes have gone up so much, you are starting to see a little bit better spread than you were before. So it's already starting, but we're just not there yet. Again, so I think you guys understand this, right? Do we have any questions on this?
Yeah, guys, who has questions for Reed on the adjustables right now? And just to give kind of like a very quick example, I think something like this, I think would be enticing to someone like Samira and I, where, we probably might buy a home for 5 to 7 years, even though we're in one now that we'll probably be in for a very long time. But generally we saw ourselves being in there no more than 5 to 7 years. And so in that case, looking at a 5.5% interest rate versus or a 5.5% interest rate on a 5-year versus a 6.125, that could be a big difference for us. That could be, maybe a few extra $100 a month that would give us a bridge, right? So that's the type of person that I think this could be good for. Does anybody have any questions before he summarizes and moves into the objections?
I have a quick question. So if I have a client that is thinking about doing a HELOC, so it's a whole separate, well, kind of like you mentioned it like an all-in-one loan, right? An equity line, right? So that's just to kind of take some equity out of the property and have it completely separate to where it doesn't mess with the loan because he has a low rate. But if he were to just kind of want to do a whole refinance and qualify on his own and make some title changes, do you think if he were to refinance, do a cash out refi and jump into an ARM loan temporarily, would that be something that would work for him as an option?
It depends on his credit, first of all, because the credit is going to be ARM products are very credit sensitive. So whereas the ARM rate might be better for somebody with a 740 credit score versus a 30-year fixed, if somebody has even like a 690, now the 30-year is going to be better. ARM pricing is very dependent on credit because it's more of a risky product. Mm-hmm. So if you wanted to pull cash out on an ARM, if his value of his house was, let's say, $1 million and he only wanted to pull out to 600,000, where his total loans you owe 600,000, that leaves 40% of equity. The ARM on that type of a loan would have a much better rate than the 30-year. So it might make sense for him to do that. I think if he's going to get rid of his current rate he has on his first, though, and do a full refinance to just put the loan under his name too, and maybe there's a divorce and he wants to put it under his name, or for whatever reason he wants it underneath his name. If he's going to give up the loan that he already has, that might have a really low rate, and pull cash out, depending on his credit and the amount of equity, it may just make sense to do a 30-year fix, or he could look at doing a 5 or a 7-year loan. This is where you'd give options and you'd discuss these things, and we'd go over the difference in payment between each option. And that's like a 15, 20-minute call to just go over the difference in payment and explain, just a simple overview on how the ARM loan does work. And then he could decide what would be better for him. But I literally, every time I talk to someone, I actually have some great call recordings that I've been doing on Ring Central. Like, I'm noticing actually how I do spend a lot of time with people. I ask them a lot of questions, not just about the money that they make. I get to know them, and I get to understand their finances pretty well. And I can also give my own advice and my own opinions. I don't tell them what to do, but I can help to put them into the right product that's going to be safest for them. And if the payment's only $100 or $150 a month more to do a 30-year loan versus an ARM, I mean, it's somebody that's just, we need to have that sense of comfort. Like, you don't want to find out that their rate adjusted up and now they can't afford their payment in 5 years. It's like about how much income they make. If they have low debt to income ratios and some good savings, then you may put them into an ARM. But I guess my answer is, like, if he's pulling cash out because he needs it, I would do a 30-year fixed, even with rates being where they're at today, over an ARM. It's safer. And somebody that needs to pull money out of their house to pay off debt, or unless it's to go buy an investment property, they're in a position, in my opinion, that you would do a 30-year fix. You go more conservative right now until we see maybe rates at 8.5%. If 30-year rates go to 8.5 and it's 6.5 on a 5-year ARM, he might not even have an option. He might have to do a 5-year ARM. So we might get to a point that ARMs start to become more prevalent. But in this market, to answer your question, I would do a 30-year fix is where I'd probably push him into, unless he wanted to go with the ARM product, right? We give them the options, show them the data, let them see it visually, then they make up their own decision on it.
Awesome. Love that. Great information, Reed. Having you break this down and take the time to do this is truly, you're speaking to things that we've wondered for a very long time, and you're really demystifying a lot of it. So we really appreciate that.